All right, welcome back here. It's going to be a beautiful day, we think. The clouds are going to clear a little bit later on. Dave Scott here, forecast in just a bit. You know, many consumers might be pretty cautious about investing their money in today's market, or maybe unaware of the number of investment opportunities available. Well, joining us this morning is Chris Tress of Bernstein Global Wealth Management with some great advice for all those people out there who are scared. They're maybe not as educated as they could be about how to invest in today's market. Good morning. Thanks for coming in.
Good morning, Tom.
Nice to have you. So what can people do if they're scared to get in the market today, or they're unaware of all the different options? There's just too many out there. How should they learn about where to put their money?
Well, Tom, there's no doubt that investors are nervous and frustrated today. If you look at 2008, the global credit crisis, most lost half their net worth, which abruptly ended many retirement plans. And as humans, it's tough for us to stay disciplined. You know, we're wired to run from danger, and that's what kept us evolving since the days of the caveman. But in investing, you know, danger typically presents opportunity. So in the words of Warren Buffett, I buy when people are scared. So in terms of today, where you can invest your money, it's really two main areas. One, so-called risky assets. So yes, stocks and commodities and real estate, they'll generate long-term growth, but there's going to be some sleepless nights along the way. And the other is safe assets, so cash and high-quality bonds. They'll give you the courage to hang in there and endure those bear markets.
You mentioned retirement and how many people have lost their money that they thought was going to be available for the retirement. How can people look long-term in more of a safe way and really confident that they're going to have money well into retirement? Maybe if they're retiring at 65 and they live to be 95, they got to have that money still there.
So clearly the goal is to not outlive your money. And you need to construct a portfolio so that it's able to endure those three headwinds that slow it down or try to. And those are inflation, stuff costs more every year, taxes on dividends and capital gains and income, and as well as your spending during retirement. And so there's sort of a shorthand 3.5% rule, and that's how much you could spend from your portfolio every year. So if you had $100,000, that's $3,500 a year, or $1 million, that's $35,000 a year. And just a quick little math example, let's say that your 60% stock, 40% bond portfolio next year went up 7%. The first 2.5 would go to, take care of inflation, maintain your purchasing power. 1% pays your taxes. What's left over, the 3.5 is what you could spend.
Okay, yeah. Well, good. That's a good way to break it down for us. There's a lot of people who are afraid, obviously, in today's market, of losing their money maybe again. So you get a lot of people fleeing those typical ways to invest and going to things like gold because it's considered safe. And we've seen the price of gold go up fairly steadily over the past couple of years. Is gold really a safe place to invest?
Well, there's no doubt that gold's had an amazing run. And there's a lot of buzz. It's hard to drive to work in the morning and not hear at least 1 or 2 gold commercials on the radio. But a lot of that momentum is based on fear. So fear of stock market risk or volatility. You have fear of the government printing so much money to prop up the economy that the dollar will fall off a cliff, and fear of runaway inflation. But that said, gold has, especially a gold-oriented portfolio, has so many downside risks. And 3 of them are: one is no income that generates in retirement that you can spend from. If you look at, as you said, retirements aren't just 5 years anymore. They're 20 and sometimes 30 years. If you look over multi-decade periods, gold has pretty much just run with inflation. It's created really no real wealth over long periods of time.
Yeah, just incrementally gone up over the years.
Absolutely.
Not a whole lot.
Absolutely. Okay. And then just finally, gold is volatile too. So in the last couple months, gold peaked in fall of last year, and it's down 15% through today. And stocks, the risky assets, are up 15%.
I want to ask you this: how can people get a hold of you if they have some questions? They want to contact you right away.
Well, we have a local San Diego office. We manage about $1 billion in local San Diego money, and we are in the UTC, and Bernstein is the firm.
All right, Chris Tress, thank you very much for your time. Great advice.
My pleasure.